Joe is the market executive for Washington, D.C. and Suburban, Maryland for John Marshall Bank. And he's been leading banking relationships for growing businesses for over 30 years. He's an expert in using proven financial tools like debt solutions and treasury management and deposit products, all or some of which maybe he will explain to us tonight. And he uses those to help corporations, nonprofit organizations, green businesses, small businesses, a whole host of different types of companies. Joe has an MBA from Monmouth University and a BA from William and Mary. And it's such an honor to have you speak to us tonight and answer all of our questions.
I appreciate the opportunity, and I'm pleased to be here. One other thing I would mention about my background is that I have, for the last 10 years, volunteered with Bethesda Green. They have a business incubator for new green companies. So I work with a lot of cutting edge, brand new ideation types of firms and talk to them very, very frequently about just what we're going to talk about today, which is how do you finance your business in its very, very early stages. So this is a subject area that's kind of near and dear to my heart, and I love going through it because it is very core to banking and business and the growth of business, which is what we're all about. So I'm going to start, and I want to go back. Hopefully this is not redundant for anyone, but before you begin to think about a loan, you really need to begin thinking about the financial statements of the company. And if the company has been formed, even at day one, there is a balance sheet. And as soon as day two comes along, there's an income statement. So let's just look at the balance sheet for a brief moment. The balance sheet is a summary of your assets, liability, and the net worth or the equity in the company. And the assets of the company are your cash, your equipment, your laptop, car, your scanner, your printer, the machine that makes your widgets or whatever it is. And then your liabilities are the things that the company owes. So those are your payables. You have payables perhaps to your paper supplier, or you have payables for toner cartridges, or your credit card bill for gas for the car that delivers your product. You have accruals. If you have an employee, even though payroll's not until next Friday, every day that they work, it accrues a certain amount of expense on your balance sheet. And then if you have a loan, that's a liability as well. So you have the assets, which you may think of as positive, and from an accounting perspective, I know that doesn't necessarily work that way because you debit for cash and things like that. But you have the positive assets, the liabilities, which are things that you owe, and whatever's left over is your equity. And if you have more liabilities than assets, you would have something called a deficit net worth. But hopefully, everybody has a positive equity situation in their company. And again, whether you have financial statements prepared, whether you do it on QuickBooks, or you just do it on an Excel spreadsheet, or even on the back of a napkin, you should have a sense of what is the company worth. That's the equity. And that is key to beginning the process of thinking about how much of a loan can I get. The next step in the process is the other important financial statement, and that is the income statement. The income statement tracks what you bring in, or what have you brought in terms of revenue. And that is what we call the top line. And you may have a variety of different sources of income. You might have sales, you might have contributions and grants and things like that. Those are your top line money into you. And then you have your expenses, and these are the things that you have actually spent money on. So you have spent money on buying your printer, putting gas in the car, buying paper, raw materials, things like that, insurance, all those things go into it. And then at the very bottom, you have whatever is left over, and that is your net profit. Now, in more advanced accounting, when you have accruals and things like that, you're going to have a line called earnings before interest, taxes, depreciation, and amortization, EBITDA. And that's a very important concept for banking. And I'm not going to dive into it too heavily here, but suffice to say that the way the bank is going to look at these financial statements, it's going to look at its income statement and say that net income or net profit, that's the money that's available to pay the bank back from a loan standpoint. So having those two financial statements in the back of your mind, let's talk about the need for financing. So once you know that you have a business and you know where you are in terms of your assets and liabilities and what you've made so far, you're going to want to do some sort of a projection and say, okay, in the next 12 months or 24 months, I am going to sell so much and I need money to buy something, printer, car for delivery. Maybe you need a line of credit, and I'll get more into these credit types, but there's something missing in your capital structure, going back to the balance sheet, that you need to fill with bank debt. And that bank debt ideally is there to help you grow. No one takes a loan to make a company weak or go down. This should give you flexibility to make the company more profitable, make it bigger, take it to the next level. So you really need to think about those types of things when you're deciding whether or not you want to take on bank debt. So what we recommend is, as you've developed your financial statements as to where you are now, an income statement and balance sheet, then you should do a projection of where you will be in 12 months, and then where will you be in 24 months. And you should look at, let's say you have a balance sheet as of today. You would imagine, where will you be at December 31st of 2021 at the year end? And you may have to say, well, I will have sold some more products, so I'll have a little bit more cash, but my inventory will have gone down. And so my net worth will look something like this. You will also need to sort of project what you're going to do in terms of your income statement. So between now and the end of the year, I'm going to sell $100,000 worth of stuff. And by the time I pay my employees and pay for these supplies and deliver it to everybody, I'll have $10,000 left over as my profit. Okay, so that means that there's $10,000 of cash available. So when you look at a projection, you really roll that same methodology out over a period of time. And then we recommend there's Excel is an excellent way to do it. It's extremely useful. You can do all sorts of fun things with it. But if you're looking for a simpler way to do it, you can find projection and forecasting models. There's a million of them on the internet. Some of them are tailored to particular businesses or industry types, and there are all sorts out there. I've seen a whole variety of them, and I encourage you, if you are looking to do some bank financing, that you look very carefully at the different projection tools that are out there for you. And they're really, even if you're not looking for bank financing, just as an exercise in business discipline, it's a terrific idea to go through and get to know that a little bit more. And let me go back for one more second to the balance sheet. When you're looking at what the company owns and what it owes, you're going to have whatever's left over. And some of the money that has started the company is capital. It's the money you put in to start things. That first $100, $1,000, $10,000. It could have come from your own pocket. It could have come from friends and family. That's called equity or contributed equity. But if you have debt, that's debt equity, and that also goes into building the company. So thinking about it from a balance sheet perspective, you take a loan from the bank. Let's say you take a loan for $100,000. You're going to have a liability, a loan of $100,000, But that very first day, you're also going to have cash of $100,000. So they will offset exactly. But ultimately, you will spend the $100,000 down out of your cash account, hopefully to build in more equipment and sell more product. And ultimately, those productivities will result in more profitability that will allow you to pay the loan down. And month after month after month, the $100,000 loan will decrease. Okay, so I hope I've framed kind of the way the financials work. So let's move on to the different types of loans. And I won't talk about just bank loans. There's a whole variety of loans that will slide into that liability section on your balance sheet to help your company grow. But bank loans are typically term loans. And a term loan is, think of it like a car or a mortgage. It's for a set period of time, it's for a fixed amount of money, and there's an interest rate and a period of time that you pay it back. So it might be a 5-year loan, 3-year loan. Bank loans for businesses tend to be on the shorter side. And bank loans to buy something, to buy a piece of equipment, are going to be tied to the useful life of that piece of equipment. So for example, if you wanted a loan for a laptop, say it's $1,000 for a laptop, typically the bank is going to say, okay, we'll let you have the money, but we have to have it paid back in 3 years. The useful life on a laptop, it may last longer, but from a banking perspective, we say that it's 3 years. A car could be more like 5 years. A printing press, that could be as long as 15 or 20 years. So it really depends on what the purpose of that bank term loan is for. There are some occasions, very rare, where the bank will just make a working capital term loan, where they just give you $100,000 and say, well, you have to pay it back over a period of time. But those are extremely rare, and I don't want to get sidetracked on that. There are also loans out there from non-bank institutions, but from financial institutions, and they're microfinancing loans. There's a number of institutions, and you may have read about some of the great work of organizations like Kiva, which does a lot of work in the developing world, where they would make a loan for maybe $150 to someone in a poorer section of the world who wants to buy a sewing machine. And that person becomes a tailor and then pays it back over a period of time, or to finance a goat to milk, things like that. Microfinance loans are typically less documented. The collateral hold is not as secure, but there's a community element to them where everybody in the town or the village effectively agrees to guarantee or be each other's watchers to make sure that you pay that loan back. They've been extremely productive, and the interest rate, while seems to be relatively low, it really has a tremendous impact on the developing world. But I think for the most part, microloans, although there are some in the United States, I believe Kiva even does some in the United States, is a less common approach. I would also say that a loan can be what we call a friends and family loan or an angel investor loan. And those type of financing situations are much more personal, where mom or dad says, here, we're going to give you $10,000 to get things started, pay us back when you can, or pay us back in 20 years, or, as long as you pay us interest equal to what we could get at a bank CD, we're fine, or something along those lines. Still needs to go on your balance sheet. It's still a liability to the company, but that is another source of financing you may want to consider. Another more flexible financing method is something called a line of credit. And a line of credit, think of it as a credit card for your business. So when you have a need for cash, you email the bank, or you go into the bank's portal and you take out $10,000 from, let's say it's a $100,000 line of credit. Generally, you don't have to explain why you're taking the money out. And generally, you have to pay it back at the maturity of the line of credit. So most lines of credit are between 1 or 2 years. Once you take the money out, you only have to pay interest on it until you have the principal to return to the bank. So it's a highly degree of flexibility. The challenge is the bank needs to collateralize or have some security to cover that line of credit. And most lines of credit are secured by accounts receivable. So if we can step back to our balance sheet for a moment and our income statement, when we make a sale, we sell something for $1,000. We deliver the product and the company says, okay, bill me for that. So you send them a bill. So you've completed the sale, but you've also got a due to you, a receivable from that company for that $1,000 piece of equipment you just sold to them. That is actually an asset of the company. It's worth something and it has value. So the banks can look at all the people that owe you money that you have billed them for, and they can secure with that. They file something called a UCC lien, and that covers the bank. So the bank will then come up with something called an advance rate. So they look at all of your accounts receivable, assuming that none of them are bad or not 10 years old and you're never going to collect it. And they may let you borrow 70% or 80% of what people are owing to you. This is a very important timing tool. So if you send out an invoice and you know that people pay you in about 45 days, you've got payroll in 2 weeks. This is a very important tool that could allow you to do that. There are also lines of credit that are secured by inventory. These are more typical if you own, for example, I did one to a scrap metal company where they had pounds and mounds of scrap cars and junk cars. Well, the steel in them had a value, and just by certain valuation methods, we could determine how tall the pile was, how much steel was in it, therefore how much it was worth. And we let them borrow about 50% of what we thought that pile of junk was worth. And they could borrow that to pay for payroll. By the time they stripped it down, separated it out, put it on a rail car, sent it out to the foundry and melted it down and got paid, that was a 60-day process. But they were able to access it while it was still a pile of junk in their yard. So inventory lines of credit are also a possibility. A little more specific is commercial real estate loans. They're very, very, very common, but typically are for larger businesses. So if you think of it as a mortgage, but for a commercial property, that probably gets you the closest to what it looks and feels like. So if your business needs to build a factory, or I was just in Alaska recently, and it seemed like on every corner there was a little tiny, and I mean really little tiny espresso or cappuccino shop. I mean, I think people in Alaska must live on coffee in those cold, dark winter months. But these little tiny buildings were all over the place, and it's basically drive-through coffee. So if you needed to buy a little tiny sliver of land and put up a shack to sell your coffee, you could get a commercial real estate loan. And that, like a home loan, gets paid back over a period of time. Home real estate loans are anywhere from 15 to, we're even seeing some now as long as 30 years. And there's an interest rate, and the loan gets paid back over that period of time. Let's see. There's another type of accounts receivable line of credit for a company, and it's called Invoice Factoring. And it's non-bank type of financing. And thinking again about your accounts receivable, what you would do is you have a $1,000 account receivable from a company because you sold them a unit. Then what you end up doing is, on a legal basis, selling that $1,000 receivable to another company that says, I will give you $950 for that, for the ownership of that receivable, and I'll take care of collecting it. And here's, you take $950 and you're done. Then they pay you, and then they collect it, and that spread that they make, that extra $50 is their profit on it. So that's another type of financing that's available when you have a lot of accounts receivable. There's specific equipment financing. If you need to buy a car, obviously, printer, again, those are going to be tied to the useful life of whatever that is. And those types of financing are provided by banks and also by leasing companies. There are basically two types of leases without getting into the gory details. Some of them are a capital lease where at the end of it, for $1, you own the piece of equipment, and you can really think of that as a loan, although it has a slightly different accounting treatment. But on the other side is where if you lease a piece of equipment for 3 years, at the end of those 3 years, the leasing company takes that equipment back and you own nothing. There's financial risks and benefits to both, but that's another way of financing equipment within your company. And then I know I've gone through quite a few. I'm going to give you two more. One is something called merchant cash advance. Now, merchant cash advance is a non-bank financing method, but if you sell a lot of your product collecting credit cards, you sell your widgets over the phone, you collect a credit card, and you send out the product to your company. There are companies that say, all right, I see that you do about $10,000 worth of credit card transactions a week. I'll give you $10,000 today, or maybe $20,000 or $30,000. But every credit card payment that comes in, I'm going to take half of it, or a quarter of it, or 10%, or 90%, depending on the terms of it, to pay us back. Now, these loans have effectively a fairly high rate of interest and are for companies that are in a startup phase. So they're perceived to be higher risks in the borrower, but the cash is very readily available. You can get these approved in as little as 24 hours, but you really give up control of that incoming cash. That incoming cash, as you're getting it paid, goes right to the merchant cash advance company. And the very last one that I'll mention, unfortunately, is probably the most common for a startup company, and that's using your personal credit. Most commonly, we see founders take a home equity loan if they own their house. If they don't, sometimes they get a bunch of credit cards and they max them out. They use the credit cards to finance that startup phase of the business. They put it on credit cards to buy the equipment, to buy the raw materials, the supplies, the laptops, all those type of things. And then they chip away at those credit card bills. Now, that credit card debt was and still is to a certain extent very easy to get. And again, it depends on your credit score. However, the rate of interest that you pay on those types of loans is extremely high. It can be up to the usury limit, but you're going to be in the high teens to low 20% per year, which is extremely expensive. Bank loans could be as low as 3% to maybe 6%. And factoring and merchant cash advance, you may have an imputed rate of interest in the 10 to 15%. So when you think of a credit card, it's fast and easy, but it will cost you in the long run. So again, now moving back to your income statement, the interest that you pay, the bank, the factoring company, merchant cash advance, is an expense, and that will decrease your net profit at the end of the year. Sometimes that investment is worth it. Sometimes, as we say, the juice might not be worth the squeeze. Okay. So having said all that, I'm going to now switch to what does a bank look at when it entertains a credit opportunity.
It sounds like there are a lot of options and that some of them are more expensive, but easier to access. And some of them you might be able to have like a lower interest rate, but you're going to have higher collateral, or you're going to have to be able to show something. The last two I thought were really interesting because I had not heard of. In fact, I want you to repeat the type. Before you were talking about the using your personal credit card. You talked about how a bank might take a portion of every credit card sale that you
Yes.
make. That's new.
Well,
Can you? Yeah.
sure. It's called a merchant card or a merchant cash advance. And it's actually banks don't do it. They're non-bank institutions that do it.
Okay.
So there's a firm, actually it's based in Bethesda. It's called Rapid Advance. You can go to their website and see their website. You can also go, there's another one called Clover, I believe is a big provider. I think actually Quicken has a division that provides this. There's a number of institutions out there, but Rapid Advance actually has a very easy to figure out website, and I know that they make approvals in a very short period of time. So that merchant cash advance is a very useful tool for a company that's starting up.
Sure, that sounds really interesting. And I'm assuming that that would be preferable to racking up your credit card debt, that what they're taking out of every credit or every purchase is going to be better than paying
Right.
20% on a credit card.
Correct. But again, it depends on the life cycle of the business. So if today is just the second day of business operations, you probably don't have any merchant sales for them to leverage. So you're in that state, you're kind of having to use your own, either the cash you put into the company or your own personal credit card. Now, 6 months from now, after you're rocking and rolling and selling stuff every day, then you have a more of a track record and more throughput in your credit card terminal. Then that may make more sense. But just again, it depends on the life cycle of the business.
Okay, no, that's really helpful. You also mentioned, you said that there are lots of different forecasting models and things that you can use as tools, and I'm just wondering if you have any that you would recommend that would be like a really simple tool that someone who is just starting out might be able to use.
I know I've seen, I'm pretty sure Quicken has one. I think you have to pay for that. As a matter of fact, I'm almost sure you have to pay for that.
Okay.
The SBA has some dummy models. They're not active. You can't really fill them out, but they will give you some guidance as to what goes into a business plan. And I'm kind of drawing a blank. Let me see if my brain thinks of a couple others. I'll try and come back to that at the end if I can think of another one.
Okay. I know that in our classes we've used, the SBA does have some templates for at least how to do your financial statements, which can be really useful. Good. Okay. Well, I'm going to let you continue, and I'm going to hold the rest of my questions.
So once you've determined what you want to finance, what's the purpose of it, and what's the appropriate financing method, let's assume for the sake of conversation that it's a bank. You need to apply to the bank. The bank is going to look for a number of things in most applications. One's going to look for those financial statements we discussed at the very, very beginning. And typically they're going to want to see 2 years plus wherever you are in the year to date. They're definitely going to want to see at least 2 years of successful business operation. That doesn't mean you have to have made a profit in both of those years, but they are going to want to see probably at least in year 1, or I'm sorry, in year 2 and year to date showing some profitability. So that's your balance sheet and your income statement plus the year to date for both of those as well. They're going to want to see the tax returns for the business entity, whether that comes as part of your tax return or if it's filed separately, to go with those financial statements. And that adds some validity to it. If you're offering the bank QuickBooks statements, I mean, we can make anything in QuickBooks, we can just put it in ourselves, but a tax return adds some validity to that. And they would want to see that the tax returns match the QuickBooks statements fairly closely. If you're having an accountant prepare the statements, then that may take the place of a tax return, because the accountant is going to do a certain degree of due diligence and will verify to a certain extent. And then they're going to want to see that business model, usually 2 years. The next 12 months, they're going to want to see in a fair amount of detail. The second year doesn't need to be as detailed, but they'll want to see that. And then in conjunction with all of that, they're going to want to see the documentation of the entity, the articles of organization, the bylaws, business licenses, all those things to prove that you are actually able to and allowed to do business. And then along that, you're going to have the loan request. And so it's important to remember when you submit this package, let's say you're asking for $100,000, in your projection, you need to show, okay, I got a $100,000 loan, and this is the way I'm going to pay it back. There should be enough cash and expense in your projected income statement to show that you're paying back the loan within that 3 to 5 years that the bank is going to ask for. If your model shows that you can't afford to pay it back, you may want to consider another financing source, because the bank is going to have a very hard time approving a loan that you yourself say you cannot pay back. So once the bank gets this, and there may be some other documents they ask for, but generally that's where they're going to go. They're going to think about things, and in banking, we call it the 3 C's. There's cash flow, is the first C, and then there is collateral, and then the last C is character. So cash flow, most banks, that's number one, because cash pays us back. And cash flow is that net income number, or if you get into more advanced transactions, that EBITDA that I mentioned before. That's the money that's free and available that can be used to pay back the loan, the principal and interest that the bank is due. The bank is going to want to see that in the projection model, and it's going to want to see that historically it's been available as well. The second piece is collateral. And that is what is going to secure the loan. And this is where I mentioned before, it's the printer, the car, the coffee machine, whatever it is that you're financing, the bank will legally take a lien on that. And I'll just take a moment to say that a lien on equipment is if you think about a house mortgage, it's the bank kind of putting their a little notice, legal notice on that thing, that asset that says, hey, you can't, somebody else can't come along and take it. We have an interest in this. And if things go wrong, we're first in line to sell that. And it's done through a legal notice, something called the Uniform Commercial Code, or UCC filing. And you file that with either the state or the county where the business is located, and it becomes a matter of official record. So when the banks look to do a loan, they're going to do something called a UCC search. And there's databases out there. We can run it and put in the name of a company, gives us the names of all the people who have an interest in the assets. And sometimes it's a general thing. It says all the assets of this company are pledged to this bank to secure the loan, or sometimes it says this car that is owned by this company, we have a first position lien on it. And if we have to sell it, we'll give whatever money's left over to other creditors, but we get paid first. So that's the collateral piece of it. And the last thing is the character, and that's the character of you, the business owner, or owners, if there are multiple ones. So for most of the loans that I talked about, particularly for the bank loans, the owners of the business will be asked to personally guarantee it. And what that means is if the business, the corporate entity, fails to make the business work, sales drop off the map, people decide to stop eating, drinking, buying, using your particular product, and the business fails, well, then you personally are on the hook, and the bank would expect that you would reach into your savings account, sell your personal property to make the bank whole. That is the personal guarantee. So when we look at the character, we're going to look at credit worthiness of that individual. We look at their credit scores, like a bank does for a credit card. What is your credit score? Have you ever defaulted on a loan before? Do you have experience buying a car and paying it off successfully? Have you been late on payments? Even things like phone bills. If you failed to pay your cell phone bill and Verizon had to shut you off. Well, that goes into the credit bureau, the credit report, and banks will say, somebody who would walk away from that obligation may be tempted to walk away from this obligation if it were not to come through or not to materialize the way we hope it would. So those are the 3 C's, and that's kind of where the banks start their process. Then the bank is going to look and dive into very carefully the documents that I discussed, and that business plan or that financial model and that cash flow is going to get a lot of attention. And the banks will do what we call sensitivity analysis. We'll say, well, this model shows that sales are going to grow 10% a month. We're going to say, well, what if they only grow at 5% or 2%? Does it still work? Try and make it as realistic as possible. If the rate on the loan changes, let's say it's a variable rate as opposed to fixed, we'll say, well, what if the Fed raises the discount rate and prime goes from 3.25%, where it is right now, to 5.25%? Can the company absorb that extra 2% interest expense going forward? Is there enough profitability in that net profit number to absorb those changes? So we will dive into those type of things as well. And then what the other thing is, we'll spend a lot of time is looking at that collateral and how much worth does it have to secure the loan. Some things are very apparent, like a car, because if you pay $20,000 for a car, there's a sales price, there's what we call a blue book value. There's a very well-known value to that particular asset. The same is true with a printer or an espresso maker or a piece of real estate. The value is very clear, and the banks will often offer an advance rate or an amount with a cushion. So on a house, for example, you really need to put 20% down. So that gives the bank a little bit of cushion, knowing if they have to sell it, that there is some equity into it already. The same is true with a car or any piece of equipment. Very, very rarely do banks do 100% equipment financing. More typically, it's 90% or 80%. I mentioned before accounts receivable as an asset that the banks can actually put their notice on that they have an interest in them. Again, those we're going to advance at a much at a rate maybe of 70 to 80%. When we make loans to government contractors, where the government says, I owe you money, and there's a accounts receivable to the federal government, we may advance as much as 90 to 95% because we have a high degree of confidence that the federal government's going to pay for that bill. If it's an accounts receivable from some small company that we've never heard of before, then maybe we'll only advance 60 or 70% because that company hasn't been around very long. Maybe we'll look into their payment history. Maybe they are not paying their bills in a timely fashion. So those will have an impact on how much we can advance on those accounts receivable. So that collateral question will have a lot to do with how much the bank can advance in terms of a loan. And then I guess finally, there's things like how long has the business been around? How long has it been successful? And I would encourage you in a startup phase or an early stage of a business, keep track of the business even when you're running it out of your back pocket. Maybe you don't have financial statements. Maybe you're kind of doing it on the side and things like that. You really should find a way of documenting that, even if it's just in text, or to tell the bank the story that I've actually been making these widgets on the weekend in my basement and just selling them to people, but I only incorporated in this year. That's important for the bank to know, that it's not something that you started last year, but you've been actually doing it for a longer period of time. And that's an important part of the equation. So I will have to say, sadly, that for new startup businesses, banks don't do a lot of loans. They need to see that track record in order to make the loan work. So what is a new entrepreneur to do? there are a couple things. There's that business credit card or personal credit card that is helpful. Friends and family is often place the new entrepreneurs go for that first round of capital. But if you get a little bit of wind behind you and you have a little bit of a track record, there are some things that the SBA does provide. The SBA typically guarantees that if the bank makes the loan and the company doesn't pay, the SBA will step in and pay anywhere from 75 to 85% of the loan, depending on the particular SBA product. There are occasions, rather rare and extremely cumbersome, where if all the banks say no, and you still think you have a case, you can go directly to the SBA and ask them, and they will make you the loan. It's a very painful process, but it is in some ways the lender of last resort that can be a resource for you. Just briefly mention that there's two main SBA, thank you, correct, Small Business Administration. I'm guilty of one of the things I hate that other people do. The Small Business Administration has two main programs. The one is the 504 program, and that finances real estate. The other one, which probably has more to do with entrepreneurial companies, is the 7A program. And under the 7A program, there's a couple of different ones depending on the size, whether it's a line of credit, whether it's equipment. And I think they start as low as $150,000 and go up to $5 million worth of guarantee. And those are programs that most banks are familiar with using. So that's kind of what I had planned to cover. I know I went over that extremely quickly and probably used more acronyms than I should have, but I'm happy to answer any questions or go back over anything if I wasn't clear on it. But that's kind of where
great.
my printed pages ended.
That is fantastic. No, I think that is perfect. And there is a question in the chat, and I'm just like I'm just like so curious. So I've got some questions for you too. But I want to make sure that we get this one. It says, is there a checklist that would work for all types of financing, like a list of things you have to do no matter what you are trying to finance, whether it's a home or a car or a business? I guess some tools.
There are. If you just type in small business loans into a search engine, our small business loan checklist, you'll get a whole bunch of them. They'll largely be the things that I just outlined. There may be some little tweaks here and there. So for example, and it will vary depending on the financing source. So if you go back to merchant cash advance, they're going to want to see your merchant cash receipts for the previous probably year or 6 or 9 months, depending how long the business has been around. Banks don't do that, so we don't ask to see merchant cash receipts. But that is something that would be necessary for that particular kind of financing. So if you just Google it, Bing it, whatever, you'll find a million checklists out there, but they're all at the heart going to be pretty much the same.
I think that's great. And it also goes to the heart of what you're talking about. What I hear from you is that you want to be able to keep really good records because people want to know that information before they lend you any money. They will need to know that. And also I'm just really taken by, we have this idea, of course, that, banks look at your credit score and that's it. And then they decide if they're going to give you money or not, but it's a very personalized process. I mean, they're looking at you and your business from a lot of different angles. So I think that for me is one of the big takeaways from what you've been talking about. I wonder if you mentioned earlier, because again, we're talking about like maybe a startup may not be able to walk into a bank and be eligible to get a loan, but there are these other options. And you talked about the microfinancing, which I find really interesting because here at Montgomery College, we actually have a project working with Kiva where students are practicing by giving out microloans to businesses that they want to support, which I think is really terrific. And that's kind of a new and alternative way of doing this. There's also, I know that some people use crowdfunding to
Mhm.
start their businesses. And I don't know if you have any experience or wisdom about that, but I know that that's something that a lot of startups are looking to use.
I have seen crowdfunding and micro loans work, particularly for the incubator, the green business incubator that I've been with.
Mhm.
That in some places that steps in for, well, Kiva expects you to pay it back,
Mhm.
but crowdsourcing is it's like friends and family money. If you have a good story and people are interested in what you're doing for either a social good or a personal concern for you, or they just want to see your product hit the street, you might be able to sort of crowdsource your way into that initial capitalization to make your transaction happen. For everybody who's got a great story about how great crowdsourcing is, there's probably 100 people who didn't get anything. I have no experience or magic solutions to offer in that. I just don't know why it works sometimes and sometimes it doesn't. I do know, especially with the green business incubator, where there is a social mission where if I only had a little bit of money, I could turn these tumbleweeds into biodegradable soda bottles, and people get very excited about that, and they tend to send money in for that just because they think this is what the planet needs. That's going to probably generate a little more interest than I'm going to make the greatest espressos out of the back seat of my car that Montgomery County has ever seen. That might get a shrug, and I'm not sure how much you would be able to crowdsource for something like that.
Right. Unless you were in, where did you say you were? Alaska or
Well, Alaska, yeah.
Right.
Lot of espresso drinks in Alaska.
Super, super. Okay, well, we have about 10 minutes, and I don't want to leave without hearing from you about your career in banking for those students who are thinking about going into finance or going into banking as a career. What got you interested? What do you think is like, why do you do what you do? Can you tell us about that, or advice for students who are thinking about going into banking?
Sure. So I went to school. My undergraduate degree is actually in political science. I was bound and determined that I was going to work for the State Department or for the federal government. And no sooner did I graduate than the government had a hiring freeze. And so there were no new hires in the federal government. And so I didn't really know what to do. And a friend of the family said, "Joe, we've got this management training program at the bank. Have you ever thought about banking?" And I didn't know anything about banking at all, but I had no job. And so I said, "Okay, I'll do it." So I got into the management training program with a regional bank in New Jersey, which was subsequently acquired by the Bank of New York. And they basically taught me everything about banking from the ground up. It was an 18-month program, and I started as a teller and learned how to open accounts, and then worked in the back office, and they showed you a little bit of everything. And then once you graduate, they place you in a different part of the bank. Once I got into the bank and was working, I said, okay, I probably should get an MBA. And so I did it at night, and the bank was very generous to pay for that. And I will add, as a pitch into banking, most banks will pay for folks to get their degree, either their undergraduate degree in business or accounting, and in many cases, their MBA. If they don't pay for it in full, then make significant contributions. So I know banking is probably not considered the most interesting of career choices, but there are a lot of tremendous benefits that banks will do, and we're having a hard time attracting new employees these days. So keep that in the back of your mind. Maybe not be your dream job, but they pay for some extra education. That's a tremendous, tremendous deal. And then I would just say that once I got into banking, I actually liked it, mostly because every customer I talked to has their own story. I'm really not doing the same thing every day. One company is a government contractor, another one's building apartment buildings, another one is manufacturing some unusual fastener that holds airplane wings on planes, or one's building a special laser that measures the distance between two blades on a propeller plane. It's just, everyone's very fascinating. When I look at the financial statements, all the same format, but everyone is very different, very, very different, which keeps it interesting for me.
Yeah, I think I would disagree that banking sounds boring from your talk, and the fact that there's so much variety, and I'm sure you get to know people very well by by exploring their needs and their wants and their records, that you have an inside look into a lot of different kinds of businesses, which I think sounds great. And as I tell my students, find a career where they will pay for your continued education. And if banking is one of those, then to me, like, big
Take
plus.
it. Take it.
That's yeah.
Absolutely. That federal government also pays too, but banking generally pays. So take it, guys. Education is expensive.
Someone is asking about projection tools that you might recommend. I guess we had talked about forecasting models. That maybe that's the same as
It's one and the same. I don't have a better one. Yeah, I'm sorry. I am just not able to think of one. I think if you just put it into a search engine and say small business projection tools, you'll find a number of them there. I would recommend actually the simpler, the better. Some of the ones are very, very complicated and industry specific, and I'm not sure that that's really worth it. You probably will make you pull your hair out trying to figure those things out. It's just not worth it sometimes. Just start simply, and then you can always add a line, add a little bit of extra clarification. But some of these things have 150 different sub accounts that are just, they don't apply in most of the times.
So do not be discouraged if you're looking for something and think it's complicated. Maybe you can find
there's plenty to choose from out there. Plenty of free things to choose for too. I wouldn't pay for one.
This has been wonderful. Thank you so much, Joe. I'm so glad that you were joining us tonight, and a lot of great information. I think that you've like laid the landscape really well, so that there's something there for everybody, no matter where you are in the growth of your company.
Thanks for your attention. I appreciate it.